Introduction. Welcome to our session on understanding price action and market structure. In financial markets, success often depends on how well you can interpret price movements and understand the market environment in which they occur. That's where the concepts of price action and market structure come into play. Price action refers to the movement of a security's price over time without the need for technical indicators or tools. It's about observing price behavior directly and learning to interpret what the market is trying to tell you. On the other hand, market structure is a broader concept. It deals with how the market is organized, how participants interact, and the mechanisms that drive price formation and execution. Together, these two elements create the foundation for informed trading and investment decisions. By understanding how prices move and how markets function, you'll be better equipped to anticipate opportunities and manage risks effectively. Throughout this lecture, we'll explore these ideas in depth and provide practical ways to apply them in real-world trading. Let's dive into price action, one of the most fundamental aspects of market analysis. Price action is all about studying historical price movements to identify patterns, trends, and opportunities. Unlike strategies that rely on lagging indicators, price action focuses on real-time, observable market behavior. A key component of price action analysis is recognizing trends, whether the market is in an upward trend, known as bullish, or a downward trend, known as bearish. Understanding these movements can help traders ride the momentum or anticipate reversals. Next, we have support and resistance levels. These are critical zones where prices tend to stall or reverse direction. Support represents a price level where buying pressure is strong enough to prevent further decline, while resistance marks a level where selling pressure tends to limit further gains. We also have chart patterns, which are formations that signal potential price movements. Patterns like head and shoulders, double tops and bottoms, and triangles give traders clues about whether prices will continue in the current direction or reverse. Lastly, we'll touch on candlestick patterns, which are a crucial part of price action analysis. These formations, like dojis, hammers, and engulfing patterns, provide quick insights into market sentiment, whether it's bullish or bearish, and often indicate potential turning points. By understanding these key concepts, you can analyze price behavior more effectively and make informed decisions without needing to rely on technical indicators alone. Now, let's talk about market structure, which is the framework that defines how a market operates, how prices are set, and how participants interact with each other. Understanding market structure is essential for navigating different trading environments and managing risks effectively. First, we have market participants, which include a wide range of players. There are retail investors, like individual traders, institutional investors, such as mutual funds and hedge funds, market makers, who provide liquidity by constantly quoting buy and sell prices, and high-frequency traders, who use algorithms to execute large numbers of trades in milliseconds. Next, we have order types. These include market orders, limit orders, and stop orders. Each type affects how trades are executed, how quickly you can buy or sell, and the overall liquidity in the market. For example, a market order is executed immediately, but it may not give you the best price. In contrast, a limit order lets you set a specific price but may take longer to fill. Then, there are trading venues. These are the platforms where trading takes place. Exchanges, like the NYSE or NASDAQ, are highly regulated and transparent. Dark pools, on the other hand, allow large trades to be executed privately to avoid impacting market prices. Over-the-counter markets provide another avenue, where securities are traded directly between parties. Finally, we have the regulatory environment, which plays a crucial role in ensuring fairness and integrity in the market. Regulators establish rules to prevent market manipulation, ensure transparency, and protect investors. Understanding how regulations impact different markets can help you avoid pitfalls and take advantage of legal protections. Together, these elements shape the dynamics of price formation and trading behavior. By knowing how market structure works, you can make better informed decisions and adjust your strategies based on the type of market you're trading in. The interplay between price action and market structure. Now that we've explored price action and market structure separately, let's bring them together and understand how they interact. This interplay is key to understanding why prices move the way they do and how market conditions can influence trading outcomes. Let's start with liquidity, a critical factor in this relationship. In markets with high liquidity, where many participants are buying and selling, price movements tend to be smoother and less volatile. This is because there are enough buyers and sellers to absorb large orders without causing big price swings. However, in low liquidity environments, even small orders can trigger large price fluctuations, creating volatility. Next, we have order flow, which refers to the flow of buy and sell orders in the market. By observing whether buying or selling pressure dominates, traders can get insights into potential price trends. For instance, if there is a significant increase in buy orders, it may indicate a bullish trend, while a surge in sell orders could signal a potential downturn. Finally, there's market sentiment, which is shaped by the collective behavior of traders reacting to news, economic data, and other external factors. Positive news, like strong corporate earnings or favorable economic reports, can trigger bullish sentiment, leading to upward price movements. Conversely, negative events, such as poor earnings or geopolitical risks, can create bearish sentiment and downward price trends. By studying how sentiment translates into price patterns, traders can position themselves to capitalize on emerging opportunities. When you understand how market structure influences price action, you gain a clearer perspective on how to navigate different market conditions. You're not just reacting to price movements, you're anticipating them based on the underlying dynamics driving those movements. Practical application. Let's now talk about putting all this knowledge into action. Understanding price action and market structure is only useful if you can apply it effectively in your trading decisions. Here are some practical ways to do that. First, analyzing charts is a core practice. By examining price charts, traders can identify trends, key support and resistance levels, and patterns like triangles or double tops. These insights help you predict whether prices are likely to continue their current trajectory or reverse. The goal is to use these observations to make informed entry and exit decisions, minimizing risk and maximizing profit potential. Next, there's monitoring order books. The order book reveals the depth of the market by showing buy and sell orders at different price levels. By observing where large clusters of orders are placed, you can gauge potential price movements. For example, if you see significant buying pressure at a certain price level, it might act as support and prevent prices from falling further. Lastly, staying informed is crucial. Market conditions can change quickly due to news events, regulatory updates, or shifts in market sentiment. A key announcement from a central bank, a change in economic indicators, or new market regulations can influence market structure and, by extension, price action. Staying updated on these developments allows you to adjust your strategy in real time. By combining chart analysis, order flow observation, and staying on top of market news, traders can make decisions with greater confidence. This practical approach ensures you're not just reacting to price movements, but proactively positioning yourself for success. Conclusion. As we wrap up this session, let's reflect on why understanding price action and market structure is so important. Together, these concepts provide a comprehensive view of market dynamics, how prices move, why they move, and what factors influence those movements. By mastering price action, you can read and interpret trends, patterns, and market sentiment directly from price charts without relying solely on indicators. Meanwhile, understanding market structure allows you to see the bigger picture, how different market participants, order types, and trading venues come together to drive price discovery. When you combine these two perspectives, you gain a significant edge in navigating financial markets. You'll be better equipped to spot trading opportunities, manage risk, and adapt to changing conditions with confidence. Whether you're a short-term trader or a long-term investor, this knowledge will enhance your ability to make informed decisions and improve your overall market performance.